This is the Friday, January 15th, 2016 version of the Market Plus segment. Joining us now is Don Roose. Don, welcome back.
Thank you, Mike.
Now, at the end of the program, we ended on a pretty bearish tone. You mentioned the variation we've seen in the dollar index over the last 30 years. Can you expand on that a little bit? Where do you think this could go? Let's talk about the dollar first. Where could the dollar go here over the next several years?
Well, I'll just be real quick on this, but the dollar's sitting around 100. But in the mid-'80s, when we had all the issues with the crude oil under a lot of pressure, the farm crisis, the dollar was at 160. Then the dollar went to down, in the 90s, down to the 80. Then we went back up in 2000, back up to 120. Then we moved back down in the crisis of 2008 to 71, and now we're back up to 100. I guess my point is people say the dollar can't go up, but it's a wild swinging currency, and it's one that can still go up because we're very much so the best of the worst out here, Mike, and everybody wants dollars right at the present time, so we'll see. But that's an anchor for exports, and it's a deflationary environment.
Now, it's a deflationary environment. Now, that's something we've been talking about. We've seen it globally in commodities over the past 18 months, particularly in the last 6 months, and we have a Federal Reserve increasingly concerned about inflation, and we've seen them increase rates, probably going to do it again. What impact would a continually tightening monetary policy have on commodities, on U.S. ag?
Yeah, well, no doubt that we are in a deflationary environment. Look at almost all the commodities. Look at the CRB index, across the board, really what happens as interest rates keep rising, and we're into a very unusual situation because we probably need to normalize interest rates, which means we need to go back to something of a normal, not an artificial situation. But as interest rates go up, the dollar gets stronger, and that's the real issue if you don't think the dollar can go up, because interest rates really do need to go up because it's just too artificially. The people on fixed income, Mike, it's really just a tragedy. It's a depression type of an era. So that's what you need to do is normalize things.
Okay. Now, I want to move to some of our questions here from our followers on Twitter and in Facebook, and I want to start out with one that you alluded to on the program. This is from Paul in Columbus, Wisconsin, and he's curious, as you mentioned, funds have been record short commodities. So Paul wonders if we get corn down to that $2.90 level, beans at that sub $8, will that be enough to have them step in and buy these lows?
Usually the way the funds they enter and exit is you need to go up, to get some kind of a technical signal to push up. So I don't see them liquidating as we continue to push lower. No, I think it'd be one that you would go to $2.90, you'd push up to $3 or something, get a technical signal to push back up. That's really the way the market works from a fund in, fund out standpoint. We've tracked them for years, and that's really the way it is.
Okay. All right. So it's if we sell strongly down to $2.90, that's really an incentive for the funds to continue to put short positions on.
That's right. They just continue to press it, and you'll need some kind of a technical up move in order to push them out, and usually that is predicated on some kind of a fundamental change. The most likely situation would be if we move from an El Nino to a La Nina quickly, we went into a dry droughty pattern quickly. That's the most obvious right at the present time, but right now it doesn't look like a big bet.
Right, and there was just a report from NOAA looking at the possibility of a La Nina. Well, what did they say?
Yeah, exactly. We just had an update from NOAA, and they're really the people that set all the standards. And what they really said is they do not see us going into a La Nina, which would be the fear pattern. They look for the El Nino to kind of base out and weaken, but they don't see moving in the other direction. So that means favorable weather conditions.
Right, rather than heading into a drought and possibly getting some kind of a price premium into these markets, we'll head to a historical average type of year, potentially.
That's what they're saying, but that can change pretty darn fast. When the year that you have to be afraid of, we had the exact same thing in 1983. We thought everything was perfect. Come back after the 4th of July, El Nino went to a La Nina, we went to a drought.
All right. Well, now I want to continue on this thought of what do these low prices, particularly low crude prices, mean for the ag commodities. We've got a question here from Chad in Dunbar, Nebraska. He's wondering, since crude is falling like a rock and the price of crude is tied or at least correlated to the ethanol corn price, is $3 corn cheap enough long term, or do we need to go lower on the corn price before we can get a fundamental bounce back to the upside?
Well, and that's a good question, but where we're really at, we're in a deflating environment. So if all the input costs can come down, we can normalize a price. Maybe $3 with a big yield is a break even at some point in time, if all the input costs come down. So I think it's premature to talk about that. When you're coming down in a deflationary environment, nothing looks right until you stabilize. But if you bring back some of these other things, fertilizer should come down, a lot. The fuel's coming down a lot. If the seed and some of these other things could come down, then your break-evens change a bit if the yield is there. But $3 right now looks like a possibility.
Okay. All right. We're seeing some inputs drop, as you mentioned, fertilizers and fuels a little bit, but cash rent, seed, and chemical are still hanging right in there. So we'll have to see what happens.
Yeah, usually takes a while for that, Mike. People just don't give up on prices just in 1 year. They usually need to take pain themselves.
You bet. All right, now I want to turn the topic over to the cattle market. We've had interesting developments for the past 2 years in cattle, but really over the past 2 weeks, we've had a couple interesting things happen. And Rodney in Edgar, Wisconsin is looking at one of those. We had that large blizzard come through the Southwest, New Mexico, the Texas Panhandle, and he's curious what, if any, impact will the death losses have on the fat and feeder cattle market from that blizzard in the Southwest?
Well, Mike, for any individual group that is in that situation, it's terrible. But really, in my experience over the years, is that really it doesn't really change the fundamentals at all. So I would say it's probably going to have minimal, if any, effect on the marketplace.
Okay. Now, our next question is from Lyle in Leicester, Iowa. In Leicester, Iowa. And Kyle is in Leicester, Iowa. My apologies, Kyle. I'm having a hard time today. So Kyle is alluding to a report that came out on Wednesday, I believe, that the cattle organization RCAF is pressuring the Senate to look into this big price drop we saw in live cattle. And he's wondering what will happen to the cattle markets if or when they open up an investigation into that price drop.
Well, the CME already has a big price discovery on stuff, and there's a lot of mechanisms in place. So I tell you, my opinion is I don't think it'll see a big change. I think it'll be a lot of news type of talk, but I think from a trader standpoint, I don't think that is going to be a market mover.
Some finger pointing and some arguing about what had happened, not a whole lot of change in the ongoing price.
Exactly. I think, what we're going to go back to is really what are the real fundamentals. Are you moving beef? Aren't you moving beef? What's the break even for the packer? I think you'll just go back to the fundamentals. And the demand actually is probably the key for the cattle market. Can you really keep the demand? What is the demand at what price of the box beef?
Okay. Well, Don, before we let you go, crude closed Friday, $29.42. Do you buy crude or do you sell crude at that price?
Well, I tell you, from a trader standpoint, you never pick a bottom because you don't know where the bottom is until you get there. So I'd be careful, wait for a signal to turn up. But we are oversold enough that you're probably due for a dead cat bounce.
Okay. Well, Don Roose, thanks so much for joining us this week. Really appreciate your thoughts.
Thank you, Mike.
Thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so. Remind your friends to check us out. We've got all kinds of stories on our Facebook, on our Flipboard, and of course on Twitter. We appreciate you guys viewing those on social media. Thanks for watching and have a great week.